Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. After that, we will be taking a brief tour through our core list of companies, and if you stick with me towards the end of today's video, I've got 3 additional trade ideas to share with you, so definitely stay tuned for that. Let's kick things off as we always do on our SPY daily time frame chart, and then we'll move on over to our sectors and wrap up the S&P with any other supporting evidence. What do we see here from a price action and structural perspective? Certainly much more of an indecisive doji on today's session, with a upper wick as well as lower wick that are both larger than the candle body itself, leaving us with more questions than answers. Now, don't get me wrong, I would say that the bears have an upper hand from a short-term momentum perspective, which we'll dive into momentarily, but if you didn't catch last night's video, we've made the case for a neutral daily trend with 2 equal highs and multiple equal lows down here at the bottom. We've really got more of a daily balance area that looks like this, and as long as we're in the balance, technically the daily trend is at best neutral. We have not yet produced a higher high, and we have not yet produced a lower low. The daily trend has the opportunity to change as and if we breach 410 on the upside or 394.50 on the downside. Now, I was just saying that the sellers probably have an upper hand from a momentum-based perspective. Let's talk about why. So in this upper wick, we are clearly seeing the lack of any price acceptance above the prior rejection point here at 402.50. We're rejecting that daily 200 SMA. That's the green moving average on your screen. We're also rejecting the upper edge of the weekly expected move, and once again, the weekly resistance trend line here. So that does strike me as being bearish. However, just because we read into the upper wick does not mean that we can't read into the lower wick. This lower wick actually strikes me as being nuanced and continuing to suggest that short-term momentum traders are in control of the market, and we are not yet seeing participation from the larger OTF players, as we call them. Reason being is that if we look at the hourly chart, I suppose this does a better job of illustrating it. Look at where the lower wick came in. Right at a nuanced area of prior structure and a retracement through the spike, which we know was produced on the Monday afternoon rally. If you're a short-term trader, this is exactly where you want to start thinking about lightening the load if you're a short, or possibly scalping it long for a dead cat bounce if the market's going to see a bounce. And it certainly did see that little bit of a dead cat bounce. It's not really that meaningful because we're still underneath that 402.50. But again, this is more of an indication that short-term momentum traders are in control of this market and not larger OTF traders that we call them, with possibly a time horizon of maybe 3 to 9 months looking for a bigger breakdown in the market, right? So 394.50 is possibly where those 3 to 9 month traders can get involved, or maybe over 410 because we're closer to the 394.50. I would certainly be more concerned about a breakdown as opposed to a just big break up and over 410. Now, again, anything is possible, and we're sort of trying to resolve this daily balance area, so it's not a downtrend until it is one, and it's not an uptrend until it is one, but I would certainly make the argument that yes, short-term momentum traders are definitely more bearish than bullish here based on the evidence that we can see in front of us. A couple of other things from the hourly perspective. The upper wick, as Jerome Powell is speaking, that forms here, is another confirmation that 402.50 is pretty solid resistance, right? He made some dovish statements about inflation moving in the right direction, but that was sharply rejected off of that 402.50. And then lastly, if we take out the Fibonacci's from the high to the low of the Tuesday session range, because we did open in the range, right, and we saw an early morning push higher, we did reject right off of the 50% retracement. If it was going to be more bullish, if the bulls were going to be stronger, it should have moved through the 61.8 higher low and then threatened a 100% retracement. Simply was not the case based on the intraday data that we see in front of us here. So sellers, the momentum sellers, at least short-term momentum sellers, do seemingly have an upper hand from that perspective. Another bearish data point here. This is TradingView, where it's a little bit easier to anchor a VWAP on the intraday sessions. Here's an anchored VWAP from the CPI gap up, right? Notice that this rejection is confluence with that anchored VWAP, keeping short-term momentum traders happy underneath the VWAP, or people who tried to buy this pullback down on the lows, they're still underwater because we are underneath that VWAP, right? So another bearish data point here on the intraday chart with the anchored VWAP. Let's go back on over to the platform here and have a look at our market internals. If you don't know what this screen is, top right-hand corner's got you covered with a brief tutorial. In terms of the volume flows, they're still net positive. We know that there may have been some discrepancies here based on the large gap up offering some skew. Same thing with the advanced decline line, but even if it is going to be more bearish on that Tuesday session, just notice that we've got no sort of moves moves down here in the trend zone from the advanced decline line. So at best, let's call these neutral. If anything, they're just not signaling any stronger sellers, no stronger sellers here either. And the same thing is true with the tick, but this one certainly means much more because this does not take into account where we are from the prior day's settlement perspective, right? This is tick by tick data. So it's positive this morning, and only, given all the selling and volatility that took place, it just moves to the zero line. If this was going to be a much more bearish data point, if stronger sellers were going to be present in this market, we should have seen a read that was like negative 5,000 on the cumulative build. Certainly not the case. To sum up the internals in sort of one brief statement, it's not that it's bullish, it's just not as bearish as it could possibly be, which continues to support the thesis from the daily time frame chart here that we should be open to a wide outcome, or wide range, of outcomes until we get over 410 or under 394.50. So a slight bearish edge on the intraday, but again, until we resolve this balance area, pretty tricky price action for anything that's longer than a day time frame type trade. Let's have a look at our market profile. If you don't know what this one is, top right hand corner's got you covered with yet again another tutorial. Main takeaway here is, again, fairly balanced, right? Bullish that the point of control accepted in the middle distribution from the Tuesday session. If it was going to be more serious to the bear side, why was the point of control not down here towards the lows? Simply didn't happen, right? And again, look at the nuance of where we bounced on the lows, retracing the spike from the Monday closing buy, right? That little rally there, and then reversing off of it, right? Thin structure down here. It's not like we had much price acceptance down on the lows during K period. So again, this is much more indicative of larger sellers not getting active yet. If the larger sellers were there, the point of control, I would have imagined, should have moved lower with price throughout time. Simply was not the case on today's session. Let's get back on over to the platform here and have a look at our sectors in terms of the trends. Let's point out where things were. So XLV led the pack, up 0.2%. XLE was at the bottom of the barrel, which is no longer at the bottom, down 1.29%. Great. In terms of the heavier weighted sectors, though, the XLK, the heaviest weighted sector of them all, was a little bit more neutral. It certainly wasn't as bearish as the XLE, down 0.75%. The XLF for financial, second heaviest weighted sector that we're watching, down around 1%. And then the XLV is the third heaviest weighted sector that we're watching, second by market cap, and that was up 0.2%. Don't forget that the XLV is technically D for defensive. We'll walk through that now on the structural chart. So we're coming into the top of the overall monthly balance range up here, and it doesn't really surprise me that we're starting to see some slowdown. We've talked about in prior videos how we need to start seeing rotation into other risk-on sectors such as the XLY, such as our, the XLC, right around in here, and it's just not the case, and we'll see that again in the ratio grid momentarily. So if this does pull back, and it certainly is starting to threaten more of a look above and fail type look, so we would expect lower, closer to 137, honestly, in this balance range here. It wouldn't strike me as being unreasonable for the chart to do something like that. This upper wick on today's session technically formed a bar-to-bar lower high and failed to close above that 140.16 right here, the top of the breakout range. So to me, this is seemingly a little bit more of a bearish data point as we move into the remainder of the week. XLC could not get in gear. This is actually a bearish data point as well. We were up here starting to make strides towards the upper third of this balance range, right? And that was all given back on today's session with an indecisive doji in the midpoint of the range. This is neutral to just being bearish, right? It's not participating in any upside in our market currently, so neutral to bearish in the XLC. Energy sector continues to reject off of that 87.50, which is a good look, but remember, bearish pressure is still bearish pressure if we're not getting that rotation, which as we just saw in the XLC is certainly, not taking place as of right now. So yes, positionally, this is a good look here, but from a rotation perspective, still not great. Let's see the XLF. What's going on here? This also strikes me as bearish, right back down on these lows, rejecting any price acceptance in the CPI range underneath 34.80. Just a really ugly chart, threatening this flush point here at 34.50, and we could easily retrace back down towards 33. Bearish data point for your market. Next up, we've got the real estate sector, which is slightly higher on the CPI read, indicating that the Fed may be able to sort of take their foot off the gas in terms of rate hikes, but right back down lower on today's session. Remember that we're neutral in here. Maybe it's a slight tailwind pushing the markets higher if we're over 39, and we're only concerned about bear outcomes on new lows underneath 34. Lightweight sector has much more to do about the wealth effect. Currently, it's kind of just a neutral and moot point for the market. Let's have a look at the XLK. What's going on in the tech sector? Certainly important here, being the heaviest weighted sector we have out there in the market, kind of confirming the look of a look above and fail on today's session with the S&P candle closed firmly back down underneath that 134.75 that we were sort of, talking about on the intraday here. Is it the yellow level? Is it the white level? Certainly looking like we've closed under both of them significantly now, with that upper wick also rejecting the daily 200 SMA. To me, it would seem likely that the XLK makes the move down towards the bottom of the range here at 129.50. That's bearish for your S&P 500, considering it's the first and heaviest weighted sector in the market. Let's have a look at the XLB materials, really lightweight sector, just coming in a little bit. Although we did produce the higher high, we're back down in this chop range, starting to look much more like just distribution up here. The threat would be underneath 80.15. Slight downward pressure for the S&P, but lightweight sector not going to make or break the market. Next up is the XLY. Certainly worth reading into this one. Again, no price acceptance whatsoever over that 143 on today's session. It's a little indecisive doji in the bulk of that original bear flag consolidation range here. Has to strike me as a bearish data point. This does not look great for your market. This is where we needed to start to see some of the rotation coming in and pushing prices higher here in the XLY. Not the case. Big bearish data point, continues to be a bearish data point for our market. So although the daily balance on the SPY is looking fairly neutral, the sector posturing is certainly not looking great based on what we've seen so far. XLU looks fine up here in an inside bar, holding up outside of the original balance right here, 6 days of balance. As long as they're above 71.40, this is D for defensive, so that strikes me as risk-off posturing for our market. Really just kind of mild, being sideways up here, but overall this trajectory does not bode well for your S&P 500. XLI Industrials up next. This has really fueled lots of the rally higher. We know that through this move here, starting to look much more like what we talked about in financials as well as the materials sector, like distribution up here at the highs, right? Technically, we had the high, but it sold off. We're getting some price acceptance sort of in the bulk of this range. The upper wick represents a rejection towards the upper portion in here. Just doesn't look great. The main concern is still underneath 99 to bring us through some of this thin structure over here. Just doesn't look as bullish as it could possibly be. Sort of a 3-bar play setting up here at the highs. I'd watch the 2 equal lows and a breakdown here to get us to 99 in the first place. That's kind of your bear catalyst to get there, right? So overall, bearish data point for your market. Nothing about this chart would suggest big higher prices immediately. Next up is the XLP. What's going on with consumer staples? This is D for defensive, so we want to see it lagging, and it's just staying stuck in the flag. So this is actually okay. If anything, I'd prefer to see the XLP breakdown underneath 75.65, and then your XLY pick up the slack, but based on what we're seeing from a price action and structural perspective, that seems to be a pipe dream at this point in time. So the posturing in the sectors certainly not aggressive or risk on by any stretch of the imagination, and we can briefly confirm that with our ratio grid here. If you don't know what this screen is, top right-hand corner's got you covered with a brief tutorial. Top 4 sectors are the risk-on sectors. Notice that the XLK shows some slight signs of improvement here out of this sort of balance that we've been watching, but just one out of the big 4 is not really enough to keep us bullish. Remember that this technically is D for defensive. It's the second heaviest weighted sector, which is why we technically need it to participate in market rallies, but overall, this outperformance from a posturing perspective is not incredibly risk-on. XLF coming off aggressively, really bad look for risk-on, and the XLY continues to struggle big time here. So overall, not an impressive look in the top 4. XLI continues sideways. Okay, fine. Not a big deal. XLC starting to flatline here. We want to get it over that descending 50 SMA if it's going to become more meaningful. The XLP is right back over the breakout point from the ascending triangle in the ratio look here. That is a D for defensive look. So again, bearish for the S&P overall. Energy perking up just a little bit, but still underneath the 50 SMA. So a better look. Utilities, not great. This is risk off, as is real estate just going sideways here. Not a great look. Again, so just as a quick summary, this confirms what we're seeing from a structural perspective on our sectors as well. Here we go with the XLY versus the XLP. And we can certainly see that we made a new lower low on today's session, not in the 50 SMA, the gold line, but just the ratio pairing itself right in here. Remember that this represents growth versus value, and value continues to outperform growth. The XLY consumer discretionary, as we've been seeing in that structural chart, just there's no getting that thing in gear, and it's really, really starting to become a concerning look for our market without that rotation taking place. Let's have a look at our dollar and see what's going on from that perspective. The dollar actually came in a little bit today, to the downside, even though Jerome Powell made some comments about, the job isn't done yet. And of course, Jerome Powell wants the dollar higher so it can continue to eat away at that inflation. And granted, it's not great for consumers, but overall, that's the path that he wants going forward. So we'll see what happens in the dollar, but continuing to get more price acceptance under the 105 does strike me as steps in the right direction. But you've got to remember, as the dollar comes off here, and let's take a look at rates while we're at it, and this kind of goes hand in hand almost. If we look at rates, they're coming in aggressively. if the rates are coming in aggressively and if the market starts to come in aggressively and both of these things are happening in sync, that's really much more of a recessionary type fear environment, because we know that as rates come in, we should start to see the XLK outperform. And if that's not the case, then again, what does that tell us? There's probably a worry about an earnings recession around the corner. Nobody wants to go out there and buy Apple if their earnings all of a sudden are going to start to plummet, and that causes that recession that we looked at in the Sunday video from the other day. One quick thing about the rate of change is that we were worried about the threat to the zero line. It's starting to get some sideways movement right underneath. Remember that as and if that crosses over the zero line, typically that does not bode well for your market, like we've seen in these instances right here. So continue to monitor that. I'll, of course, keep you updated if we do get some sort of significant change. Let's now take a look at the fundamental data. We know that on today's session, we got the 50 basis point rate hike from the Fed. That was to be expected. But going forward, we've learned a couple of things on today's session. Primarily is that there were some revisions in the bearish direction, the more hawkish direction from the Fed today. The terminal rate was revised in the upward direction, somewhere in the neighborhood of 5.1 to 5.4%. As that terminal rate, which was up from the prior projections of the previous SEP. And we also had GDP revised in the downward direction. Again, more of a threat to that recessionary type environment that could be around the corner. So we're going to continue to monitor how the TLT is performing. We'll have a look at that chart momentarily here. But so far, the next rate hike is anticipated to be a 25 basis point rate hike, bringing us up to 400 to 425. I wish the probabilities tool was slightly more accurate here. A second ago, so this must have just updated. It was wild all over the place. But even with this look here, this is starting to sort of second guess the Fed's credibility, right? We just said that the terminal rate had been revised to roughly 5.1% on the low end. Why is it that the market's pricing in now a terminal rate of 425 to 450? Again, I don't know if the tool is slightly off or if it's trying to call the bluff of Jerome Powell. We, of course, know that Powell doesn't want to have any sort of a dovish tone out there. If he does, the market's going to take off and undo a lot of the demand side sort of efforts that have been done to crush that demand and bring inflation back down under control. So he has to walk that line very finely. But the market here is actually calling his bluff, right? So saying 425 to 450 for quite a while, I might add. And again, that first rate cut is coming in around November. We'll see if this gets updated into the remainder of the week. But so far, this is quite the interesting look here. Let me make that a little bit larger for your screen. But regardless, unfortunately, we've got to immediately move on to the next screen. So back on over to the platform, I do want to talk about that TLT and the slight outperformance that we're continuing to see over here, which again is much more of a threat that the market's sort of sniffing out those recessionary fears in the TLT bonds, right? So certainly look at the curling up that's taking place here. If I could get my white pointer, there we go. Curling up in terms of relative strength to your S&P. That, of course, is not good for your S&P 500, right? That means that bonds are more attractive here. Investors taking that more classic flight to safety in the bonds. Let's have a look now at, let's go to the VIX. Let's look at some volatility products. Thanks for tuning in, by the way, and sticking with me through this portion of the video. Greatly appreciate it. Hit the thumbs up button if you've made it this far already. So let's take a look at volatility. Volatility came off aggressively even as the market was coming in over the past 2 days. And granted, it's primarily because the uncertainty of the economic data is off the table now. But what this would tell me is this marries up more closely with what we just saw on the Fed tracker tool, right? This is kind of calling the bluff of the market, saying that, hey, we kind of know that things may be okay from an inflation perspective, from a Fed rate hike perspective. If you just hold it at that longer or at that lower rate, but for longer, that's okay. That's okay. And that's kind of what the VIX is telling us here. Again, calling the bluff of Jerome Powell here. But, not out of the woods yet. We can certainly still see bounces off of the 2050 support, which, of course, would usually correlate in a downward move here for the S&P 500. So still have to resolve the 2050, but so far steps in a more comfortable direction for our market, especially when we pair this with the under the hood of volatility, which is the VVIX. Remember in last night's video, we talked about this fake break here. It's not like we accelerated after the comments from Jerome Powell today. So again, calling the bluff on his higher for longer around 5.1, certainly would seem that volatility is content with the market hanging out here and not really coming much lower. Just, sideways to maybe slightly higher is okay based on the volatility perspective that we're seeing here in the markets. The last one we'll look at is, of course, our VIX futures and whether or not we are in a contango versus backwardation. So there's the front and back month volatility futures. Here's the 9-day versus the 30-day VIX. You can see both of them came in aggressively, continuing to reiterate that the spread between the front and back month here. The delta between the two is actually increasing instead of decreasing like what we saw in anticipation of the economic data that we got throughout the course of this week so far, Tuesday CPI and today's FOMC. So far, this means that money managers should be more content actually allocating capital here now that all the cards are on the table, right? The Fed has said their piece. The CPI numbers have come in. There's really no major catalysts that could potentially send the market much lower unless it's a black swan event that really no one would be prepared for in the first place. So volatility is kind of confirming that, hey, be aware that this daily balance area is actually quite comfortable for our market here. So overall, I think that the broad market is positioned for a little bit of volatility continuing in the downward direction, but I wouldn't push my luck on downside activities until we actually break down underneath in the SPY, as we've been pointing out, that 394.50. Let's have a look at the QQQ. What's going on across the remainder of the broad market here? QQQ, very similar, just in the midpoint of this balance right here, perhaps even more central to the midpoint. Remember that your edge does not exist here. It exists at the top for a breakout or mean reversion. Same is true, but opposite off the bottom, mean reversion or a breakdown. Just like in the SPY, the upper wick is pretty significant, bouncing off of this prior resistance point in here, indicating no acceptance from the buyers, underneath the top edge of the weekly expected move and staying underneath the weekly trend line. So all the same psychology is there in your QQQ. I'd just give you the numbers. We've got 281.25 unlocking the down move for the big, stronger sellers, and 293.75 on the upside for the stronger buyers. Currently, just being in the midpoint of this range, again, I would not be married to particular outcomes one way or another. I'd keep it, smaller time frames, day time frame stuff only, and then get more convicted as we move over or under the top of this balance. Perhaps the most important broad market index is continuing to be the small caps, and this is actually where we see a big red flag for our markets. We can be a little bit more definitively bearish here inside of the IWM. Reason being, if you tuned into last night's video, you already know why, but we've got the lower highs in place, and look what took place on today's session. We had pure acceptance underneath the bottom of the range, right? This upper wick would show a look into the original range. That's this right here. So we looked into it on the upper wick, and where did we close? Back down underneath. So to me, much more bearish here in small caps, being in an indication of risk appetite for the market. This certainly does strike me as a red flag, and again, more of a bearish data point. So watching for breakdowns of 177.66, 50 SMA here on the IWM to be more of a catalyst for downside in our market potentially, which runs counter to the VIX. So again, trying to keep a very balanced approach here in the market, weigh all of the data points, but this is still certainly a big concern for our market. Let's blast through the core list of companies. I think what we'll find is that markets are in a pretty difficult position to be traded here, and anyone who tells you that it's been easy the past couple of days, let me tell you, they're lying to you, right? This is no walk in the park in terms of navigating this volatility. Hopefully these videos have helped, but overall, Apple does strike me as being slightly more bearish with these continued lower highs being put in, all of these equal lows threatening a flush point underneath 140.43. That would continue to be a primary look into the remainder of the week. Ideally, maybe we get a price bar that looks like this on Thursday, and Friday offers the breakdown through that range. Any bounces in here, incredibly difficult to play back into the upside of these large red-bodied bars. So again, anyone who tells you that this is an easy chart to navigate, they must be guessing or blindfolded. I have no idea. Continuing along, Netflix. What's going on with Netflix? Talk about difficult. Upper wick, hammer, gap up, fail, indices of doji, right? We've got this kind of range in here. I would say very similar to the broad market. Patience over 332.67, underneath 312.50. Really, I think the stronger flush would be underneath 303. We've been reiterating that on the downside for Netflix for quite some time. It's been one of the stronger names out there in the market, so play with caution on the downside in Netflix. Tesla, one of the weaker names out there in the market, and this is much easier to recognize what's going on here. Of course, big rejections underneath that 177.12, little consolidation doji towards the lows, setting up a 3-bar play. It is starting to get a little bit, extended to the downside, so maybe it's not an aggressive short here, but it certainly is a short underneath 155, looking for that continuation. There's really not a whole lot of weekly support until we come all the way down to 112. We talked about that this morning on the pre-market live stream. If it does bounce, you're just looking to reposition for a short up against 170 here inside of Tesla, taking advantage of that daily downtrend. What's going on in Google? This is another difficult one. So Tesla was probably the best and easiest of them to interpret. Google looking a little bit difficult, closing back in the range here after looking underneath and moving back above on today's session. Really a little bit more difficult to trade here. I would watch to see if we get continued acceptance over and under. Trying to say those at the same time results in a weird word, under. Anyways, The more time we spend above 94.64, the more meaningful it becomes for a possible look below and fail, in which case 94.55 would be your upper, 98.55 would become your upper target. So I'd watch for that, maybe staying in this balance range, just going sideways. The concern, of course, is that if this is a head and shoulders pattern and we do start spending more time underneath 94.64, it's all about this gap down underneath us. Now, again, the gap fill reversal from today's session does make it a little tricky to play into the downside immediately, but this gap range would be the attractive area to trade short if the head and shoulders pattern does pan out to the downward direction. Next up is Meta. What's going on with Zuckerberg's fantasy land over here? This chart actually looks tradable, right? We've got a 2-day balance in play. We've got a gap overhead and we've got a gap underneath us. So very simple. Take out the 2-day highs, look to close the gap here. Take out the 2-day lows, look to close the gap here. You're looking at 124 as an inflection point to the upside, closes to 128.40, and on the downside, underneath 118.50, closes to 115.75. Simple as that in Metaverse. Let's keep it moving right along. Next up is NVIDIA. What's going on with NVIDIA? This is a bullish looking chart. Gap fill reversal on today's session, respecting that 200 SMA. If we do continue to sell off, I just watch for the higher low off of 168.50. Concerning underneath 168.50 for sure, but so far, based on the intraday data, let's take a look here. Right? Bear flag pulling back, but look at how precise that gap fill reversal is. Again, short-term momentum traders may be taking place on the downward direction, but overall, the clear sentiment of the daily trend is up, right? We've got a big bull flag breakout taking place. If we get a more meaningful reversal off of this, I would certainly be willing to play this in the upward direction. So NVIDIA looking for pullback buys that either present themselves over the gap fill, so back above 178.50. Again, here's the hourly chart. Notice that if we recapture this with a higher low, inverted head and shoulders on the hourly, game on, up and over that level, right? That's how you would look to play this. If we don't pull back lower first, if we do, it's all about holding on to that 168.50. So NVIDIA does look tradable, unlike something like your Apple. Next up is Microsoft. This one is a little bit tricky as well. I would say that it still has more of a bullish edge than a bearish edge. The inverted hammer on today's session does strike me as concerning. Also, lack of acceptance in that overhead gap, failure to fill it on the first day higher as well. But overall, look at where we've continued to support. Today's an inside bar, technically, by the way. We've supported above this breakout point, 256, right? Here's the hourly chart. Notice that, again, it's a quick wick underneath, but then right back above for the close. So it looks like the buyers are trying to hold on to that 256 prior breakout point from here. I would stay, kind of neutral in the inside bar, but really favor more of an upside outcome just based on the current trend that's starting to unfold and the recapture of this breakout point right here. Last but not least, the mini beast, we've got Amazon. This is a tricky one. For most of the same reasons. Here's a balance range. We had to look below and fail. Technically, we gapped to the top of the range. Now we're at the bottom. Looks like it may have been a short underneath the lows, but now we printed a hammer candle on today's session. Will it bounce off of this prior resistance, which is now offering support? Maybe there's something to do over this hammer high, but you don't really have much range to trade for. I would say Amazon's much more comfortable on a break over 97, or just at this point, get us underneath 86 here and move into that 82. That's a much cleaner range to be trading for. This is a fairly difficult range to be resolving. Let's move into some of these trade ideas now. The first one is going to be on ABT. ABT is Abbott. And Abbott is a simple outside bar. So we made a new higher high, failed to get price acceptance at those highs, closed underneath the low of the prior day's session, inverted hammer looking for a short under the low, close the gap. That's your trade here. So underneath, let's put some numbers to the screen here. Let's try the different tool. And one more time, the low is going to be around 110.50, closes the gap down towards 109.50, about a $1 range to trade for there in Abbott. If you do it with options, might be worth your time. TSM, this is more of just a reminder that this is still stuck in a contractionary phase. Remember, contraction leads to expansion. If we get a break, it's possible that it heads up closer to 92. If it breaks to the downward direction, you're looking for a gap close towards 74. So in all truth, there's 4 trade ideas today because the next one is SQ, and then we've got Caesars after that, which had multiple downgrades. TSM was really just more of a reminder. Here is a 2-day balance, very similar to Meta, honestly. So if we crack the highs, looking for the equal high here, let's put some numbers on the screen. Over 72.35, target high here, 75.75, and of course, underneath the lows, very simple, look for your gap to close around 66.74. So either way, available here in SQ. And then the last one we've got is CZR, which of course had a downgrade this morning, really suffered on the gap down. But look at this flush point, right? So if the sellers are going to step into this thing, if based on the downgrade, people are like, all right, let's lighten the load. We no longer want to be involved in Caesars. Look for a breakdown of this flush point at 48. And then you've got a big gap underneath us as well to start looking for as potential targets. So 46.16 is the top and it closes down at 43.83. One last thing for anyone who's stuck around until the very end, I forgot to include this chart during the broad market analysis. So if you've made it all the way to the end, if you're seeing this chart, let me know in the comments. Say something random. That way no one can catch on and no one can just leave a comment. I'll know it's random because you'll make it very random, right? Look at the upper wick on the SPY. Certainly not suggesting any bullish price action, but it's still stuck in this balance range. So, okay, neutral until proven otherwise. Same thing in the QQQ. Big upper wick on the weekly bar that's forming here, but we're still in the midpoint of this range. The big difference is IWM. Here's the range. Upper wick is showing pure rejection of this now as overhead supply, and we've closed underneath the balance range. So this, again, is much more of a data point for a red flag for your market. Let me know something random in the comments if you saw this very final chart of our 3 broad markets on a weekly basis. And with that being said, we are going to wrap up the video. If you learned anything new, let me know in the comments section or by giving the video a thumbs up. If you appreciate the analysis, thumbs up will also do. And we'll be live tomorrow morning at 8:30 as we typically are to give you the pre-market prep. With that said, I wish everybody a green trading week.